Hello. In this video, we'll be talking about the average cost retail method versus the conventional retail method. In a previous video, we talked about the retail method and what it is. It's a way of estimating the ending inventory at cost and the cost of goods sold for companies that are very big, such as retailers that have high volume sales and low price units. So they have a lot of inventory, such as a Target or a Walmart. The average cost retail method calculates the cost to retail percentage based on the weighted average of the cost and retail amounts for all the goods that are available for sale. If you recall from videos earlier in this chapter, that companies using the retail inventory method, which is what we're talking about, report the inventory on their balance sheet at the lower of cost or market, and that's when they had to compare the cost versus market, and they had to report the lower of the two. And there's a retail method called the conventional retail method. Oh, it's right here. The conventional retail method that estimates the inventory and cost of goods sold in such a way that the lower of average cost or market is built into that estimation. If we look at, the retail method of how we calculate it, we have the cost column and the retail column. When we do the conventional method, which estimates a lower cost of market, we include the markups in the retail column and then calculate the goods available for sale, which is used to calculate the cost to retail percentage. However, this is the main difference. The markdowns, the net markdowns, are not included, right? They're not included in this calculation. And what that does is, just by virtue of the calculation, it lowers the cost to retail ratio. This will go down if the 8,000 is excluded, because your denominator is now higher because the markdowns are excluded. If the denominator is higher, your percentage is lower, which reduces your estimated inventory costs. And that actually reflects the decline in market value without directly adjusting inventory to market. And it just makes it more conservative. So your ending inventory, this ending inventory right here, ends up being lower. And that makes sense because the markdowns mean there's some sort of market decline. That's why companies have markdowns. And if there's a market decline, then that means that there's a potential for needing to lower our inventory balance because the market might go below the cost. We're going to get into a detailed example to calculate the conventional retail method. But before we do, I want to go over some elements, I guess they call it, that are for calculating the cost to retail percentages. And if you recall, we start with our beginning inventory plus purchases, but the purchases are actually net purchases. And we've learned this from previous chapters. The net purchases are our purchases that, right, we buy inventory, our company buys inventory, but sometimes we have to return purchases, or we have discounts taken on the purchases, and those are going to be, depending on what it is, if it's a purchase return, you will show a deduction from both the cost and retail columns, versus a purchase discount is just a reduction in the cost column. We also have freight in, which is cost that companies incur while transporting their inventory. It's the transport cost essentially. and that's an additional cost to inventory. There's also what's called abnormal shortages. There's normal shortages, but there's abnormal shortages, and they're deducted for both cost and retail. And so there's just a lot of nuances between what, depending on the element versus how it's treated for the purposes of the calculation. So I think the best way to see it is to go through an example. And I'm going to use this example right here. I'm going to increase my percentage. I'm going to hopefully increase. Nope, can't do that. Okay. So here's an example, and we have just a company, and we're given this information. We're giving our beginning inventory, purchases, freight in, purchase returns, net markups, net markdowns, normal spoilage, sales, and a bunch of other things. So we're going to go through these one by one, and we're going to calculate first the average cost retail method, which we went through in a separate video, and then the conventional method. So let's start. We start with our beginning inventory, and we're given here the cost and the retail amounts for beginning inventory. So that's right here. Let's just highlight that right there. Next, we have purchases, and we're also given the cost in retail, and that goes right there under plus. We increase each column for the cost in retail for purchases. So we've dealt with that. Next, we have freight in. Freight in increases our cost of inventory. It does not affect the retail amount. So because we're not going to mark up our freight in. So really, freight in is just goes under the cost. It increases the cost column. Next, we have purchase returns. And when we return a purchase, we return at the cost, but then we also return it at the retail amount because we've included them in our purchase increases. So purchase return on cost and retail is $3,4,200, and that goes right here, and you can see it's a reduction. So we've dealt with this. The next item are net markups, which we have dealt with before, and that's going to be an increase in the retail amount in the retail column. And so now we've dealt with this number. Next is net markdowns, which is also goes under the retail column. However, and this is where we see some changes. Under the average cost retail method, the markups and markdowns go into our total goods available for sale, which will be our denominator when we calculate the cost to retail ratio. And that's right here. I'm going to scroll over to the right, and I am also going to calculate the conventional retail method, and that's mimics more of the lower cost of market. There, so far, except for the marked up to this point, the two methods are identical. Where they differ is when we have markdowns right here. And you'll see average cost, we have the markdown reduce the retail column. And in the conventional method right here, we do not. It is ignored. So it does come into play, but not in the cost to retail ratio calculation. So when you look at the average cost retail method, my numerator for the goods available for sale is the 76,200. It's the same thing for the conventional method as well. My denominator for the average cost retail is 106,800, which goes right in here and gives me a cost to retail ratio of approximately 71%. When I scroll over to the conventional method, I'm going to reduce this a little bit just so we can get it all on the screen. My denominator, right, I don't have the minus 5,000 right here. My denominator now is 111,000 rather than the 106 under the average cost retail method. And So now I calculate my cost to retail ratio for the conventional method, and I have my 76,200 for my numerator, 111,800 for the denominator, and so my cost to retail ratio is 68%. So you can see that the cost to retail ratio under the conventional retail method is going to be lower than the average cost method. And that comes into play in a little bit. So let's continue with our calculation. We have done the average cost retail method right here. We've gone to our cost of goods available for sale. Notice here, these are the numbers used for the cost to retail ratio, but it is not the goods available for sale. We still have to account for the markdowns, which is the next row. And at this point, I'm going to lower my my retail column, and my goods available for sale is now identical to the one under the average cost. It's just not the amounts used for the cost to retail ratio. Okay, so now we're going to continue with our calculation, and we're going to go here. So we have dealt now with the markdown section. We have something called normal spoilage, and normal spoilage are goods that have been lost, damaged, stolen, just inventory that has not actually been sold, but we no longer have that inventory. So when we're calculating our goods available for sale, it's just as it sounds. These are goods that we intend to have available for sale. We know that normal spoilage is not going to be available for sale because we can't sell it. So therefore, anytime we have normal spoilage, we are going to reduce our ending inventory number for it at retail. However, it does not go into our cost of goods available for sale number. So it is deducted from the ending inventory at retail number, which is right here, this number right here. Right here is my $1,800 normal spoilage, but it's just after the goods available for sale. And then the reason why it's marked normal spoilage, there's a thing called abnormal spoilage, and when there's abnormal spoilage, it's for items that we did not expect and do not know about, and so we would include in the goods available for sale because at that time we just didn't even know that it wasn't going to be available for sale. Okay, so now we're at the point where we have our beginning inventory plus net purchases, and now we have to reduce our goods available for sale less normal spoilage by the net sales. So in the previous example, that was just like if I'll go here, it was just a very simple example. This was given in the previous video where our net sales was just given to us as 50,000. In this example, we're given several different points. First, we're saying, we've taken care of the normal spoilage. First, we're given sales, and it says net of employee discounts, meaning that our sales have been lowered by employee discounts. Employee discounts are not factored into the ending inventory. We are told that employee discounts is $2,300. So which means that really our sales are 100,000. It's 99,300. We also have what's called sales returns when people return inventory to us, and there's sales allowances, but we don't have any in this example. But just so you know, both sales returns and sales allowances are a reduction to the net sales amount. So let's go here and we're going to calculate our net sales, and they are identical whether it's the average cost method or the conventional retail method. And here we start with our sales of $97,000, and we have to exclude our employee discount that's embedded in the $97,000. So we add it back to our net sales, and we have minus our sales returns of $5,000. So our net sales is $94,300. Again, the same under both methods. Now we're ready to calculate our estimated ending inventory at retail. And what we're going to do is we're going to take our goods available for sale, which is the $106,800. Again, it's the same thing for the conventional method as well. Less our normal spoilage, less our net sales. And that gives us $10,700. Again, notice both methods give us the identical ending inventory at retail, which is correct. Here's where the differences come in, and this has to do with the markdowns being excluded in the cost to retail ratio for the conventional method. We're going to take our ending inventory at retail and multiply it by our cost to retail ratio, which is 71% here and 68% in the conventional method. So under the average cost, we're going to take our ending inventory of $10,700 times the 71%. It gives us an estimated ending inventory cost of $7,634. And then we can calculate our estimated cost of goods sold because we have our beginning inventory plus our net purchases minus our ending inventory equals our estimated cost of goods sold. And we go here to the conventional retail method, go through the same exact exercise where we take our ending inventory times our cost to retail ratio, which is going to be lower than the average cost retail method. And now our ending inventory at cost is $7,293. And therefore we can calculate the estimated cost of goods sold. I want to focus right here on the estimated ending inventory cost. You'll see that the inventory at cost using the conventional method is $7,293, which is lower than the $7,634. And that's what we mean by that the conventional method factors in the lower cost or market. It takes a more conservative approach to calculating your cost to retail ratio, and therefore if there are markdowns, it will always result in the estimated ending inventory cost to be lower, which is basically what the lower of cost or market tries to do in in keeping with a conservative approach of accounting.